Hello and good day to all my students. This is the second video presentation for the topic under lesson plan week 4 to week 6, which we have already started with the first video lecture titled Management of Working Capital. So this lecture, we're going to look into the details of the working capital itself, which is the management of current assets. So these are the topics that we're going to cover for this session. We're going to start off with the introduction, and then we're going to look into the details or the items under the current asset, which consists of inventory. Under the current asset, we have inventory. We also have accounts receivable, cash, and also marketable securities. So in the previous topic, we talked about the management of working capital, which consists of current assets and current liabilities. Thus, in this topic, we're going to focus on the management of current asset, mainly inventory, accounts receivable, cash, and marketable securities. We start off with the management of inventory. So what is the goal whenever we want to manage our inventory? The goal is to keep the inventory level as low as possible in order to prevent unwise investment in excess resources. So why do we want to keep inventory level low? Because inventory is what we call as a non-value added cost. Yeah, if you want to manage the inventory, to hold the inventory in the warehouse and such, we need to incur costs to do so, and these costs do not translate in the productions of the finished goods. So we need to eliminate this, or at least maintain the inventory as low as possible. So there are 4 techniques that we can adopt. One is the economic order quantity, the ABC system, just-in-time system, material requirement planning system. So let's look at the first technique, which is the EOQ. EOQ, you already have covered it in part 2 in diploma, where you learned about the fundamental of costing and the introduction to the costing itself. This is just a recap for you. So EOQ model will determine the optimal size per order for an inventory item, considering its expected usage and ordering and storage costs, so that the total inventory cost can be minimized. Okay, so what are ordering costs? Those are what we call as administration costs to place and to receive orders, such as writing a purchase order, processing the purchase order, and then we want to check the receipt of the inventory with the invoice. Okay, what is the holding cost or storage cost? Storage cost and holding cost are the same thing. This is the variable cost per unit of holding an item of inventory for a specified period of time. Okay, so if we want to hold the inventory in our warehouse, we need to incur some costs, such as storage costs, insurance costs of holding the stock, cost of deterioration. Sometimes because we hold the stock for too long, some stock may deteriorate or obsolete, and also the opportunity cost of fund invested in inventory. Yeah, when we invest in inventory, our cash are tied in form of inventory, meaning that we should have already received the cash when we sell off the stock. But when we keep the stock in the warehouse, the cash is tied in the form of inventory, and therefore we cannot use the cash to invest elsewhere. In EOQ, we also have learned about reorder point, which is the reflection of the firm's daily usage of inventory item by identifying the number of days to place and receive an order. So it means that once the inventory item falls to the reorder point, we need to place new order based on the EOQ that we have calculated. The second technique is ABC system. This is just a way for us to classify the inventory, which are divided into three classification or three categories, which are the A, B, and C. So category A investment, the value of investment is low number of unit but has the highest value of investment, meaning that the cost per unit for this investment is high. That's why we only have a fewer number of unit available. Because of the expensiveness of this type of inventory, when we want to manage the inventory, we need to verify it daily so that it will not be stolen or it will not be damaged. Closely monitored by running a perpetual inventory system to see whether the old stock has been sold off or not. For part B category, this is the moderate between the two extremes, which are the A and C. Okay, but for category C, the number of units are high, meaning that we have a lot of them in the warehouse, but the total value of investment is the lowest because the cost per unit is very cheap. Because of the insignificant cost attached to it, we do not verify it individually. Instead, we apply a to-be method whereby the inventory are verified and checked in bulk rather than an individual unit or item. The third technique is just-in-time system, where we minimize investment in inventory, whereby materials are ordered in such a way that they arrive just in time when they are needed for productions, meaning that we do not keep the inventory in the warehouse. Instead, the inventory are ordered when they are needed. Therefore, in order for the material to arrive on time, cooperation and good relationship must exist between the firm, its suppliers, and transportation companies that the firm is linked with. Okay, the material must meet the required high quality standard that has been set, because we do not want to waste our time verifying the product that we receive from the supplier, whether it is up to the quality or the standard that we wanted, whether what we order is just what we have received. Okay, the responsibility of verifying the correctness of the product must come from the supplier. This will result in manufacturing efficiency. Therefore, this system eliminates non-value added costs by eliminating the non-value adding activities such as storage inspections and waiting time. The fourth technique is by adopting material requirement planning system. This is a computerized system that will determine the type of material to order and when to order them using the EOQ principle to determine the amount to be ordered. So this is an automatic system where the system will automatically determine each product's bill of material, inventory status, and manufacturing process. They also simulates material requirement by comparing production needs to available inventory balances. Okay. And then the system also detect when orders should be placed for the various items based on the time it takes for the product to move through the production stages and the lead time required to get the material. Therefore, MRP system can lower the firm's inventory investment without unduly affecting production. This is a computerized system that is the management of the inventory. Okay, next one is the management of accounts receivable. So what is our goal here? The goal is to collect from debtors as quickly as possible without losing sales from high pressure collection technique. We do not want the accounts receivable to remain as it is. We would like to collect the debtors as quickly as possible, but not to the extent our customers are running away because we are pressuring them for too much. So there are several processes that you need to go through. One is, before we can give any credit sales, we need to select who should we give the credit sales to. And then once you have given the credit sales, you need to determine the credit standards. And then after giving out the debt, the credit sales, we need to monitor and collect the debt. So we go to the first process, which is the process of credit selection. So this selection process involves the applications of technique to determine which customers should the firm give credit sales. We cannot simply give credit sales to whoever come to our company. We need to screen first our debtors. Customers who are given credit sales may be selected based on the following criteria. We look at the customer's character, meaning that the reliability in the payment. We look at the customer's capital based on their debt to equity ratio. We look at the customer's capacity, whether they have the needed cash flows for the repayment. We look at the customer's collateral. In the case of liquidation, do they have any valuable asset to secure the debts? And we look at the current condition of the economy and industry. So based on this criteria, the customer can be assessed by a process we call as a credit scoring, where we give score to the customer from a simple set of questions, and then we compare them with our own predetermined standard so that we can make an informed credit decision quickly and cheaply. Okay, after selecting our credit sales debtors, we have to determine the credit standard. Okay, credit standard is based on a credit term, that is the A/B net C, the one that we have covered in previous video lecture. Okay, credit standard. Let's say that our credit standard is 210 net 30. So we have the choice to either tighten the credit standard, or we relax the credit standard. So if we tighten the credit standard, we can see that the C has been reduced, meaning that instead of giving 30-day grace period, we only give our debtors 20-day grace period to pay back. Okay, this is a very rigid credit term. Or if we want to relax the standard, we can increase the C period by increasing it to 50 or 60. Okay, the longer the C is, the more relaxed your credit standard is. So what are the effects if you are adopting a tight credit standard? Okay, of course, when we adopt a tight credit standard, the account receivable will be decreased. Okay, we also decrease our bad debts. However, we're going to see that our sales and profit are also decreased. However, when we adopt a loose or relaxed credit standard, we can see that the account receivable will be increased, and thus increase the probability of the debt becoming bad. However, on the other hand, this standard can increase sales and thus increase profit. So you have to remember that cash discount acts as an incentive for the customer to pay earlier. Discount decreases the firm investment in accounts receivable, but it also decreases profit. So you need to do some sort of cost and benefit analysis to see which method is beneficial to you. Okay, after that, we need to monitor the debtors, and then we need to collect the debt from the debtors. Okay, credit monitoring is a continuous review of a firm's account receivable to examine whether customers are paying based on the credit terms stated. Okay, we cannot leave it to them and assume that they will follow the credit term dictated by us. We need to monitor them. So the monitoring is done by calculating the ACP, the one that we have learned in the previous chapter. And we need to prepare the aging of the account receivable to see which account has overdue and undertaking effective collection technique. So aging of account receivable require the debtors to be broken down into group based on the time of origin. The schedule will show accounts receivable that has been outstanding for a specified period of time. So these are the steps we undertake when we want to collect debt from the debtors. Step 1, we send the letter first, a reminder letter. Step 2, once the letter is proven to be ineffectual, we make a telephone call to remind them of the overdue debt. If the telephone call do not succeed, we send a personal visit for immediate collections. And then if it fails, the firm can turn to collection agency or an attorney, and we only take legal action if the amount collected is large enough to cover for the costs. Right, and then these are the factors that affect the size of account receivable. We have credit and collection policy, level of sales, nature of business. Okay, for nature of business, large supermarket usually sell on cash basis, whereas manufacturing firms primarily sell on credit basis. For credit and collection policy, if we adopt a strict credit and collection policy, then the account receivable will be small. For level of sales, the higher the sales credit volume, of course, the higher is the account receivable balance. Thirdly, we look at the management of cash. Our goal is to strike an acceptable balance between holding too much or too little cash. Okay, if you hold too much cash, then we lose out the opportunity to make profit, to make income from the temporary investment. But if you are holding too little cash, then we might face a problem of unable to pay short-term obligation that comes due. So we need to strike an acceptable balance between holding too much or too little cash. So what are the motives for holding cash? We have 3 motives that you need to know. First is the transaction motives. It involves with the regular cash outflows such as payment of wages and utilities and etc. Precautionary motive is where cash acts as a buffer for unexpected needs that might arise, maybe in form of the cash itself or marketable security that can be liquidated quickly. This is for safety purposes. Speculative motive, where cash are held for potential profit-making situation. For example, purchasing raw material in bulk in anticipation of a fall in price to reduce costs of sales and increase profits. So how do we manage cash receipt and cash payments? Okay, we look at first float. We need to manage float. So what is float? Float is time taken between 2 processing methods. For example, like mail float is the time taken between the mailing of the check and the receipt of the check. Okay, processing float here is where the time taken between the receipt of the check and the deposits into the bank. Okay, and clearing float is referring to the time taken for bank to clear the deposits. Okay, so we need to reduce collection time, especially if we are collecting money from our debtors. So we can use a lockbox system whereby payments are mailed to the post office box to reduce float. If we ask our debtors to pay directly to the lockbox system, then we can reduce the mail float, the processing float, and perhaps also the clearing float. However, when we want to pay our supplier, this is where we receive money from our debtors. But when we want to pay to our supplier, we must take advantage of the floats in order for us to increase the payment deferral period. But we have to be careful, not to the extent that we are damaging our relationship to our suppliers. Alright, and we could also reduce the clearing float by concentrating the cash into one pool. For example, we only use only one bank, which is suitable for which we can use to create a large pool of fund for short-term investment. Okay, amongst technique that we can use to concentrate our cash is the DTC, automated clearing house transfer, and wire transfer. Okay, the next one is zero balance account. This account allows a firm to keep all of its operating cash in an interest earnings accounts. Yeah. For marketable security, there are two reasons why we would like to substitute cash to marketable security. First of all, it can be substituted for cash due to the speedy conversion to cash. Right? Not only it can be used as a temporary investment, it can also be converted into cash quickly without losing its value. Meaning that if I purchase 1,000 of marketable security, when I sell the marketable security, I can get back the 1,000 ringgit. It can also act as a temporary investment when inventory and receivable are low, meaning that the current season doesn't require us to use a lot of cash. The extra cash that we have can be invested into the marketable security for the purpose of meeting the financial requirement, such as for tax purposes or for the interest generating purposes. And these are the selection criteria. Whenever you want to invest in a marketable security, you need to look first for the financial risks, for the interest rate risk, for the inflation risk, for the marketable risk, marketability risk, and rates of returns. Okay, financial risk, we look first whether the borrower is able to pay us interest on the security that we traded. Interest rate risk, we need to go for the shorter maturity security so that it will be less sensitive to the changes in the interest rate. Inflation risk is where the purchasing power has been reduced due to the flow of time. Marketable security is referring to can the security be sold immediately at a price close to their market price. And lastly, the rates of return, it depends on the four risks that we have discussed earlier on, whereby high risk usually give us high return. So that's the end of chapter management of current assets. There's no calculation involved in this chapter. Next would be the management of current liabilities. So please go to the next video lecture. Thank you for your time. Thank you for your time, for your patience, and for your attention.